Hello, Rat Pack episode 3. Mike,
How's it going?
doing good. Well, I was talking to my girlfriend recently, and she had a bunch of money in her bank, and she didn't know what to do with it. And I told her something that you said to invest in an ETF called SGov. What is SGov?
I mean, it's not just as gov, but you should just be putting your money in a money market if it's just sitting there, right? If you're using it for daily expense or something like that, this is probably not a good idea for you. You should just keep it in the bank account. But if it's sitting in your checking, you're not making any money on it. In a money market or an ETF like SGOV, you basically make the short-term treasury rate, which is right now just under 4%. So it's better than nothing, especially if it's just extra cash you're not using. And money markets hold a lot of different things besides treasury bills from the government. So having an ETF like SGOV that only holds 1 month treasuries is just taking away a risk that could happen. Where there's a lot of loans and other alternative products in money markets, and there's always risk with those, even though it's small. Whereas treasury bills, much lower risk, lending to the government.
So wait, what is the money market composed of? What is it filled with?
It's supposed to be around 80% U.S. government, debt, short term, 1 to 3 month bonds. So not 30-year bonds or anything like that. Because we've seen bonds increase and decrease in price, and a money market's designed to always be worth $1 as a security.
Mm-hmm.
So owning long-term bonds is not possible.
Mm-hmm.
So most of it is 1 to 3 month treasuries from the government, U.S. government, and then the rest are loans, securitizations, mortgage, anything. They can put just about anything in the money market in that leftover 20%. And in your insurance fund, whatever that's invested in, they can put even more, in these alternatives. So owning an ETF that only owns the 1 month treasuries just eliminates the risk of some of those loans and maybe riskier securities going bad.
So wait, what is a treasury bill? Like a T-bill?
Yeah, I mean, all a treasury bill is a short-term U.S. government debt. So say the government needs to finance Trump's new palace or whatever they want to build.
Yeah.
Right? They say, okay, well, we don't have any money at this moment. Let's raise some debt. And who do they go to? They go to the American public. They go to the banks. They go to foreign countries. Whoever buys debt as a investment, and they hold an auction. Once every week. Sometimes they hold auctions for 30-year bonds. Sometimes it's 1 month bonds. It's all a strategy based on getting the lowest cost of debt. And they issue these papers that have a stated interest rate based on the market interest rates, and they issue debt to build their roads or whatever they need, and the investors who give them the money get the interest payments and the principal as a bond. Right now the 10-year bond, if you wanted to lend the government money for 10 years, you'll earn just under 4%. And that's it's a pretty simple market, but it's extremely large, extremely complicated in some of the plumbing of who's buying it, how do they buy it, but it's pretty simple to understand.
Okay, so why wouldn't I use the high yield savings in my bank? Why would I use SGov versus my bank high yield savings account?
The thing is, just banks don't offer the same rate as the treasury states, because where do the banks get their money? They get it from depositors, and they get it from raising debt, or they borrow it from the government. And if they're borrowing it from the government, they're going to pay at least the 10-year treasury rate. So if they, give you the 10-year treasury rate on your deposit, as a form of funding, they won't make any money because they're paying 3.5% to you, and they're using that debt to buy loans or investments that are making 4 or 5%. And that small of a spread, they cannot pay their employees and throw a Christmas party, whatever they're gonna do, and it's not enough to survive on. So banks usually have to make a spread of 3 to 4% between the money they give you in your high yield savings and the money they're making on loans. And so right now the average loan yield, if you just approximate it with all the banks, is around 6%. So if they have to make 3% to survive, that means they can only give you 3%. And so 10-year treasury is yielding just under 4. So there's a almost 1% spread between what the bank can offer you and what the straight treasury bill, if you just bought it straight from the government, will offer you. And that's how the bank makes money, but it hurts you if you buy those products. You earn less.
Okay. So what are the main ways other than that, that the bank makes money? Because they really like it when people put their money into them, and then they use that money to invest in treasury bills, but do they also invest it at anything riskier?
Well, I mean, the biggest thing that a bank does is make loans.
Yeah.
They buy treasuries only when they can't make more loans,
Okay.
or people are just not looking for loans, or whatever the case is. If they can't make loans, they'll buy treasuries and just sit on their hands. But buying treasuries is less profitable for them because loans are riskier, which means the bank earns more profit, more yield, right? So an average commercial real estate loan right now, a bank is making around 7% interest on it. And the best way they like to make money is from checking accounts. So you put your money in the checking account with the bank, and say you put $1,000, the bank is allowed to use essentially 999 or 990 out of that $1,000, and they can go make a loan to your neighbor's business, and they'll make that loan at 7-8%, and they're paying you nothing on your checking account. So they're just making 7 or 8% free, and that's that most of the bank's profit comes from that. They make a little bit less on people who put in high yield savings or a CD, because they have to pay them 3%, and they lend it out at 7. So 4% spread, still pretty good. And banks right now are in really good shape, and they're pretty profitable.
Okay, yeah, that makes sense. I'm gonna guess if they make a bunch of loans and they don't get paid out on those loans, and it happens at a very large rate, that will make them bankrupt. What makes a bank go bankrupt and kind of fail? Because it seems safe, but I know a lot of banks that would fail.
Well, I mean, there's multiple ways to blow yourself up in a bank, and most of it is because of the leverage that's in banking, right? We just talked about how they have a 3 to 4% spread to make their money. And so say a bank has $1 billion of loans, they make a 3 to 4% spread on that. That bank makes around $30 to $40 million every year in profit. And, that's just too small. So banks use leverage. And all that means is essentially they take your depositing money and then they raise equity or raise debt, and they amplify that amount of deposits by 10, and that's the money they hold as capital in case loans go bad. They have this reserves, and the reserves overall it's regulated at 1/10 of the total loans has to be held as reserves for losses. And so in general, if loan losses right now are on average 2%, and they go up to 4, that completely wipes out most of the bank's profits, because they're making a 3 to 4% spread,
It's leverage.
but it's leveraged 10 times, and so the 2% increase in delinquencies or people not paying it back, charge-offs, it would really hurt a bank. It would completely wipe out its profit, make it unprofitable. And most of the times, that would be okay. They raise more capital, but what happens when a bank starts to, go into the negative profit territory? People freak out, and everyone who's holding the money in that bank, the depositors, they freak out and they say, okay, I'm going to get my money out of this bank, because they don't want to lose their money. And if your deposits go down a lot, that's your funding source. That's what you're using to back the loans. And if those disappear, you have these loans that are going bad, and the collateral that's backing it essentially is going away. And then the government, knocks on your door and tells you, it's time to close up.
Yeah. So it seems like a bank, more than other companies, truly needs the trust of its users and customers.
That's the only thing it needs.
Yeah, just trust.
For sure, yes.
Yeah.
That's completely correct. Everything in banking is based on trust.
Yeah. Like the brand name of that bank. So we've talked about it before of Silicon Valley Bank. And we did it it was only 5 minutes, but
Yeah.
have you looked into that a fair amount to where you kind of know how it ended? Because it was the fact that they were investing in 30-year treasury bonds, right?
Yeah, I mean, essentially what they...
Yeah, give the full story of Silicon Valley Bank. Or if you know.
Yeah, I mean, essentially, I was pretty active in the banks at that point, but, mostly after Silicon Valley and trying to figure out what happened. I didn't spot Silicon Valley. Many smart people did. And they saw, what was wrong with the bank and, what could go wrong. And essentially, what happened is what we just described, but in a little bit different sense. In that Silicon Valley's loans didn't go bad. During the pandemic, right, the government poured trillions of dollars into the economy, the stimulus checks and the, free rent and, pay for your whatever, your medical costs. Everything was pretty much free for quite a while, even after the economy opened up. And so a lot of excess money was just in people's pockets, it was in companies' pockets, and they put it in the bank because they didn't know what else to do with it. It's too much. And so, like we said before, right, banks usually make loans because those are the highest yielding, best profitability product. But if you have trillions of dollars suddenly come into the deposits, into the banks, they can't make trillions of dollars of loans just like that. The government made $1 trillion appear in a second, but the economy can't increase $1 trillion worth of loans overnight, right? And so what they did instead was buy treasuries. And so if you just bought 1 month treasuries and you roll them over every month, you're essentially taking no price risk, right? That bond is always worth $1 around, and you get your interest for that month. Because, interest rates affect bond prices. So if a bond has a higher interest rate, it is worth more. If a bond has a lower interest rate, it's worth less because you earn less, right? You want to pay more for something that pays you more, and you want to pay less for something that pays you less. And so Silicon Valley bought, 30-year bonds. They locked up their money for 30 years with the U.S. government at, 1% because interest rates were 0% at the federal level, at the Federal Reserve level at that point. This was pre-2022, inflation spike, and, rates went up from 0 to 5%. Because, the economy is running too hot, you have to raise the interest rate to discourage people from, going out and buying. You want to encourage them to save because now they can earn 5% by saving. Before they were making 0%, so why save? Just spend it all. Right? And that's why the economy gets too hot and you have inflation, because the demand for every product is too high because there's no incentive to save. And what happened is, if you buy a bond at 1% and now the Fed is auctioning off bonds at 5%, your 1% bond is worth nothing. Because a guy can go into the street and buy a bond that's yielding him 5 times more right now. So why would I want to buy yours that's a 1%? And so those dropped in value, over 50%.
Yeah, that's insane.
And so, that's a similar idea to, losing 2% of your loan book. That's a massive hole in your, balance sheet. And because the banks are levered 10 times, they don't have enough capital to offset that. And the depositors, a lot of venture capital firms, large depositors, billions of dollars, they all pulled out overnight. And,
They lost their trust.
And they lost the trust because they went out onto the market and said, oh, we need to raise equity to cover this hole.
Mm-hmm.
And once people looked and saw, what was really going on, it was all over, So banking is, pretty risky business.
Yeah. What makes a successful bank? Just giving out good loans and then also using your kind of extra money some more safely.
I think, the biggest thing that a bank should do to succeed is not chase growth, right? All the bank failures we've seen, all the major collapses we've seen is because the banks went out and they got greedy and they chased growth. And so the biggest thing in banking is not to focus on necessarily loan growth, but to focus on minimizing losses. Because if you're leveraged 10 to 1, every loss has a 10 times larger impact on you, right? So does a gain, right? If you make 1%, now you're making 10 because you're levered 10 to 1. But they don't really, when you're growing your loan portfolio 30% every year, 20% every year, like Silicon Valley was, like some banks are now, some of the new banks, online banks, like they're doing today, right? It's not possible that there's that many credit-worthy borrowers in the system. Because at the end of the day, a bank is a bank, and the bank is there to give you money. And so whoever gives you money at the lowest rate, you'll get the loan with them. And if you're growing your loans 20, 30% and the economy is growing 2%, that means that, you're taking a whole lot more risk because you're making much, much more loans than the economy is actually demanding by, building, growth is building new factory. You need a loan for that. Growth is, opening a new business or building, a new distribution center or whatever. And so if you're growing at 20, 30% and the economy is only growing 2%, that means that you're making loans to borrowers that are not credit worthy, that were turned down from maybe some of the larger banks or banks with tighter, standards on what they lend. And so you're really taking a lot more risk than it looks like on the surface.
Yeah, that makes sense. And then also it's like, you said the whole growth thing, that bank shouldn't really be focusing on growth. And we've talked about the stock, SoFi, and it kind of seems like a lot of what you said of what a bad bank does, they do, in that they give out loans to kind of low FICO score people and riskier people. And I don't think we talked about it before about their technology platform.
Yeah.
What is that?
Yeah, so, SoFi bought this company called Galileo, and it's called Galileo Technologies. It brands itself as a financial technology company, and at the end of the day, what is it? It's a loan broker, and a loan broker essentially goes out and finds borrowers for you, and gives them to you and says, okay, Bank A, I found this borrower for you to make a loan. That's revenue for you, so let me get a piece of that revenue for finding it. It's a finder's fee business. You're finding borrowers that a bank wants to make loans to. And, this is not technology at all. It's growing extremely fast because, the appetite to lend to anybody and everybody is just exponential. All of this extra money that was there, during pandemic, the stimulus check, all of that, that's all being used right now, right? We're funding $100 billion data centers and, you know, massive refinance of student loan debt and credit card debt, which, you know, that's SoFi's specialty. But, you know, at the end of the day, that technology platform is an extremely volatile business. Broker is extremely volatile because, you know, when there's a lot of demand for loans, your business does extremely well. But the demand for loans fluctuates a lot. And especially if, you know, you're referring the type of loans that SoFi does, which is, you know, below 700 FICOs, you know, bad credit history, maybe not even employed, no income check, no income verification, none of it. So, you know, if those loans start to go bad, that business disappears overnight. And so that doesn't really feel like a technology company to me. And, you know, SoFi is valued as a technology company. But, you know, under the skin, if you peel it away, what is it actually? It's a half subprime, half prime lender. And, you know, that's half more subprime than the average lender. Because banks don't do subprime because it's so risky.
Yeah. And then you also said that some of their delinquencies are going up to 10%, and if that happens, then they won't be able to sell off some of their loans.
Yeah, so, you know.
And that's happening right now, to where you said it's an interesting time to make them, to go against the stock.
I mean, you know, now is the time because losses are accelerating in all aspects, in all sorts of subprime credit. From auto to especially student loan, right? Student loan delinquencies have gone from essentially nothing to 8 to 9% within maybe 3 to 4 months post student loan pause, you know. And in the short term, it really, really benefits SoFi actually because they're refinancing people who can't pay their federal student loans. But, you know, the issue with the student loans today and the ones that SoFi is refinancing, especially the federal ones, is that these borrowers haven't had to pay for 3 years. And half of them, you know, are going into one of the worst, you know, negative growth job markets. You know, huge affordability costs. Just a really bad market for, you know, new graduates. And they haven't had to pay their loan for 3 years. So they built their lifestyle around the money that they have now, you know, and, you know, in the next 2 to 3 months, those student loans start turning on 2,000 to 3,000, and they're like, I can't pay this. So they go to, you know, someone like SoFi who would refinance that loan for them, give them a lower rate. And, you know, all is good. SoFi gets, you know, a bunch of loan growth, a bunch of new income, a bunch of new revenue. And that's why they're growing so fast. But at the end of the day, you know, you're reporting on your books, this is a great borrower, they have a 750 credit score. But that's because their lifestyle is built around handling their bills that they have today. And we know that, you know, the average savings of the United States American is $500 every year, right? You save $500 every year. That's the average. And so people are pretty much living up to their income, spending mostly all of it. And now you introduce the student loan, which they haven't had to pay for 3 years due to, you know, the CARES Act, Biden's CARES Act, the student loan forgiveness. You know, you don't have to pay because of COVID and whatever. And on paper, this person looks great. They have a really good credit score, but that's because they've been able to handle the current debt. Now they have this new, you know, $1,000 payment. I don't know if they can pay that. And so you'll see on all of SoFi's presentations, right? Oh, we only lend to, you know, extremely educated individuals, lawyers, doctors, you know, all of that. And, you know, those are the industries that are getting hit the hardest, and those are the ones with the highest unemployment. You know, lawyer unemployment over 30% right now. Yeah, you know, new graduates, right?
Wow.
Doctors, no, you know, doctors' unemployment is normal. There's still a very high demand for doctors. Lawyers, you know, computer scientists, even business people, you know, there's very, very low demand compared to how many people there are in the market looking. So it's very difficult, and I think that these loans that are supposed to be prime, which the ones that SoFi keeps on its balance sheet, are really, kind of terrible. And the ones they're selling off and, garbage paling off for gain on sale accounting profit, those are, absolutely garbage. And that's the reason why they're selling them off. And, taking huge losses on some of these securities, right? They take 50% write off on some of these loans, but it's all good because we don't have to report it on our books. And that's the price to pay, right? So if you factor in all of those, losses from making these bad loans, they're really not making much money at all, if anything.
I think that's like a cool part of investing, to where you've when I guess you looked into the employment rate of lawyers and or some of the other majors because of this bet on SoFi, or were you just interested in it? It's cool that you're diving deeper into that.
I mean,
You have to.
sometimes you just observe things, right? You read something in the paper and it says, I mean, that's also a dangerous thing, right? Just to read something in the paper, but you have to go look, at the actual data after if it's interesting. But, I saw this opportunity because student loans had been basically written off for 3 years. And I talked to many people and they all think that, these loans will never have to be paid. And then, maybe they haven't found a job yet, which is extremely common because, youth unemployment rate as a total is over 20% in the United States. So 20% of the people taking out, large student loans at this point, because the cost of education is so high, they don't have any income to support it now. And it's been okay, and that's why the loss rates have been so low, because there was nothing, there was no one forcing them to pay. They were in forbearance for a long time. And SoFi, basically what they do is they see people that, are in underwater on their federal loans or another private lender, and they say, oh, we'll refinance it for you, we'll give you a lower rate, and everything will be great. Use our app, use our saving feature, whatever. But, those loans are generally considered as very, very safe, because the last 3 to 4 years of data has said, 2 to 3% of these borrowers have defaulted. But now that you have the stress of multiple student loans at once, 50% of SoFi's borrowers are graduate or, advanced degrees. So that means, they might be paying off 2 to 3 student loans at once. And so the budget just does not make sense, especially considering the unemployment rate within the population. Some people are not even making enough to pay the monthly payments, the interest payments, let alone, the full principal.
Yeah, I was talking to this guy over the weekend, and he's 40. He studied finance at IU. He's a pretty smart guy, but he had a cool measurement of how the economy is doing. If people, specifically college grads, can get jobs, is one of his recession indicators. In general, is that seen as a recession indicator, which is probably a very popular term.
I mean, I don't think traditionally, no, it's not viewed, as a recession indicator, but it definitely tells you a lot about the structure of the economy. And in, today's world, it shows that, the top of the top, the executives, the technologists, the people at the top are holding most of the wealth. And they're just getting more and more and more of it. And the people trying to, struggle and start out have the least opportunities. And that's exactly why the people at the top are getting rich. Because the people at the top getting rich are getting rich not because, companies are growing insanely fast, the market is growing fast, lending is growing fast, all these technologies, AI, whatever you want to call it, is growing extremely fast. And so all the value goes to the owners and the investors, and then the people who run the companies, like Elon and Sam Altman and whoever you want to name. You know, people know all the names of these biggest, most richest people. Some guy's 50 billion the next day. You don't know.
Yeah.
But they're getting rich because they're cutting the people at the bottom. Half of it's coming from growth, half of it's coming just from laying off people. You know, Meta's growth in earnings the last 3 to 4 years, half of it has come from accounting changes, and the other half has come from cutting expenses, laying off 100,000 people. Same thing with Amazon. Same thing with Microsoft. Most of their profit growth has come from mainly accounting changes, which is fake earnings, not real earnings. Understating depreciation. That's not real earnings. That money has to be invested later on. It's not a hit to earnings today, but 5 years down the road, it is an expense. So there's a lot of interesting things, and there's a reason why the market has done so well that maybe people don't really understand.
Yeah, you're talking about the accounting of some of these companies. You've also talked to me personally about the accounting of SoFi.
Yeah.
So we talked a little bit about it in the first episode, but what are some other accounting things that they're doing that are a bit odd to make themselves look better?
I mean, just for starters, SoFi follows GAAP, and SoFi have no reason to think they're breaking the law or doing anything illegal. But the way that SoFi accounts for its business lines and how it characterizes business lines, that's where you get to fraud, because you're misrepresenting the quality of your business, the nature of it to your investors. And if you write something in an annual report, you write something in a press release, that's like signing an oath, and it's saying I knew that this was true at the time. And the biggest reason why SoFi earns a profit at this point is something called gain on sale accounting, which is SoFi makes 80-90% of its money from interest income. So that's just people paying back their loans. Very simple. That's what a bank does, and that's what SoFi does. So I don't see any technology companies which earn 90% of their income from collecting on loans. That's not a technology company, first of all. It's a bank. And so, first of all, just at the point, SoFi markets itself as a technology company, so they're going to use technology company accounting gimmicks, earnings before interest, taxes, and depreciation for a bank. It makes no sense because the bank's biggest expense is interest, right? The bank pays you interest on your deposit, and then it lends it out for loans. So if you calculate, and tell your investors, oh, we earned 300 million, earnings before interest, taxes, depreciation. That's like not counting your employees as a cost, right? Interest as a cost, because a bank cannot function without paying interest on its deposits. Nobody would put their money in the bank, and so that's one way they like to report a lot of growth. Nothing wrong with it. They say it's a non-GAAP measure. Nothing wrong with it. The biggest thing is the gain on sale account, and that's essentially non-cash future payments if the loans perform up to the assumptions that SoFi sells to third parties. And those are the loans that we were talking about before that are really, really bad and have a very low likelihood of paying back. And so when SoFi sells this to private equity or a private securitizer or a pension fund or whoever they sell these securities to, they recognize a gain, basically saying that this person will pay me fees over the life of the loan for me collecting the payments on these borrowers. And if loss rates are at 10%, the investors aren't making any money, the amount of loans you get to collect on gets less and less because you have to charge them off and kick them out because they're not paying. And so that income is booked today as profits, even though SoFi hasn't received a dollar yet. So if they assume over their internal calculations that 5% of our loans will default, which means they will collect this much in fees for collecting those loans. What happens if they're 10%, like they are now? If it's 10%, that becomes an expense. That's not a gain. That's a loss, right? Because if you assume you're going to gain $20 million servicing these loans, collecting these payments, and you really can't collect on 10 to 15% of those, all your fees are gone, and now you have to backstop the security and put up the capital to replace the money for those investors, or you let the whole thing go bust, in which case nobody will ever buy your loans again. And if that happens to SoFi, their entire business model is gone. Yeah.
Hell yeah. I enjoyed this. Learning about the banks was cool. Alright, I'm done calling a wrap. Sweet, see you guys.
So yeah, thanks for having me.
Yeah, no problem. Keshav, you're my co-host. I think there's more than a guest at this point.
No, once the blackjack guy comes.
True.